right. Hello, everyone. I'm Kobe Kushner. I'm an analyst here at Red Cloud. We're about to hear from the team at EnviroGold Global. So this is a company that's looking to reprocess mine tailings. It's probably one of the most unique companies presenting today, as it doesn't actually own their assets. Rather, they acquire metal recovery rights and form profit sharing agreements with the owner. So joining us is JC and Zoya. JC and Zoya, you have about 15 minutes, which will follow with about 5 minutes of Q&A. Viewers, feel free to ask your questions at any time, and take it away.
Thanks a lot, Kobe, and thanks everyone for joining us today. We're very excited to tell you our story, and the story is really all about metals without mining, and we'll see today the tremendous economic and environmental benefits that come along with this really unique business model. I'll flip through here. We've got a couple of standard disclosures. Most people should have the deck. They're available on our website. So what we do, we reprocess mine waste and or tailings in order to recover precious, critical, and strategic metals. How we do it is with a truly world-class team. Our executive chairman, David Cam, and founder is essentially a serial entrepreneur, 35 years of experience, a number of successful ventures and successful exits. His most recent venture resulted in a Fortune 100 company acquiring a controlling stake in the firm that he founded. At the executive level, we're led by Dr. Mark Thorpe, 35 years of experience in metals and mining, over 30 countries, chairman of the board of the Canadian Mining Innovation Council, and a PhD in mine land rehabilitation. Zoya Shashkova, our CFO, joins us today. Deloitte EY background, incredibly experienced, 15 years in metals and mining as a senior executive, has raised over $1 billion in capital. And then you can see there Philippa Veris, a member of our board, just highlighting the diversity that we bring to the table. One of Women in Mining UK's 100 Global Inspirational Women in Mining. The gentlemen there on the right sort of make up the core of our technical team, and about 80 years of combined metals and metallurgy experience between them. We'll learn more about their roles in allowing us to do what we do in just a moment, but just to emphasize, it all comes down to the team, about 500 years of collective metals, mining, metallurgy, and capital markets experience. And it's this world-class team that allows us to do what we do and to do it successfully. So I'll look at real quick the market opportunity that we're capitalizing on. And tailings, as many of you know, are the byproduct of mining and mineral processing, and often contain significant quantities of valuable, precious, critical, and strategic metals. The global footprint of mine tailings is absolutely massive. It's almost 300 billion metric tons of tailings in place on the face of the earth. About 13 billion metric tons of tailings are produced annually. The picture there on the lower left gives you a sense of what legacy tailings can look like. In the lower right-hand corner there, you see a little South African town, sort of legacy mine tailings sort of looming over the little town there. So there's a ton of this stuff out there, and there is a tremendous amount of metal that remains in tailings because recoveries are never 100%. Sometimes they're much, much lower. There's about $3.4 trillion worth of metals in global tailings, and through site-specific analysis, we've identified 8 major projects. That number is always growing, and those 8 major projects represent a $10 billion opportunity. So a little bit about our business model and how we're transforming a massive market opportunity into a highly profitable and highly scalable business model. So we leverage an analytics-driven approach. That gentleman, Ian Hodkinson, our chief geologist, is an economic geologist who's second to none. He leads the process whereby we've identified and examined to date over 300 tailing sites. Actually, it's about 325 to date. From the examination of those sites, we've identified 8 major projects and counting. And our business model is all about scalability. So we partner with leading EPCM companies, and we leverage those partnerships in order to get multiple projects in production in parallel at the same time. So this is a completely different business model. It truly is scalable. When you look at the proportions of tailings projects that we've identified, we think there's hundreds of projects that meet our definition of what a major project would look like. So we're very selective. What we look for in a major project is down here at the lower left. It's about 6 million metric tons of tailings, about $124 per ton of gross revenue potential. That implies that a major project should be capable of producing about $100 million per year in gross revenues. We target a project life of less than 10 years, and we target commercial metal production in less than 24 months per project. The longest lead time there is the permitting and environmental component, because we are engaging with regulators to reduce the environmental footprint of legacy mining. We find that this is a major differentiator for us, allows us to earn and maintain social license. So the net result is that we have projects that generate high free cash flow over a relatively short project life, very high internal rate of returns, and we expect to have 7 major projects in production by 2025. You can do the quick math there. Massive potential, not just for the market, but also for the business. A couple of key differentiators here, and in the interest of time, I won't dwell too long on this slide, but the Ontario Mining Association tells us only about 1 in 10,000 mineral projects becomes a producing mine. So there's a tremendous amount of risk, as we all know, associated with conventional mining, tremendous amount of investment and time that goes into developing mineral projects. Our approach is completely different. If you look down there at the sort of the blue timeline comparing us to conventional mining, it's a matter of months and tens of thousands or hundreds of thousands of dollars to develop a project to where it's ready for project specific financing. Again, we look to get into commercial metal production, in less than 24 months. And really our key differentiators are quite nicely summed up in this chart here on the right. So if a typical mineral project in the industry is going to have an IRR in the 20s, we really don't get interested in a project unless the IRR is 50 or more. And frankly, we've looked at projects that have potential IRRs that are as high as double that. So very high internal rate of return. And then the carbon footprint. This is another major differentiator. It's never been more important to earn and maintain social license. And not only are we reducing the environmental footprint of legacy mine waste, we're also producing metals with a carbon footprint that's about 96% less than the industry average. So major differentiators for us. And I'll touch now on our major projects, and we'll look at first our project pipeline, and then we'll look to 2 projects specifically, the Buckens project in Newfoundland, Canada, and the Hellier project in Australia. I'll just get the laser pointer going here. So we do have a global tailings reprocessing portfolio. We've got 8 projects in the pipeline to date. 2 of those projects are under definitive binding agreements. And our process is we don't own the sites. To Kobe's points earlier, we were able to sidestep a lot of the upstream liabilities that come with site ownership. And what we do is we acquire, once we've identified and qualified an opportunity, we acquire the rights to reprocess the tailings and recover the metal from the tailings. And so we leverage a profit sharing model with the site owners. We think that creates a very strong value proposition for site owners and allows us to, and has allowed us to, achieve a significant amount of growth in our project acquisition and development. The 2 projects we'll look at today, and I'll jump into them here in just a moment. Again, Buckens in Newfoundland, Canada, Hellier in Australia, 2 very interesting projects that highlight the different ways that our business model can identify and create value for shareholders. So the Buckens project, this is a legacy mining project, and I'll just go ahead and jump into it. Essentially, the Buckens project, the history there is an Asarco mine, 16 million tons that were processed, very high grades of multiple metals there, zinc, lead, copper, silver, and gold. The operations there were primarily base metal operations in terms of what was really driving economics. And unfortunately for the environment, but economically it created an opportunity, is that for about 40 years of the 60 years that the mine was operational, the tailings that were processed were dumped directly into the Buckens River. And there they formed a massive deltaic tailings deposit. And so what we've done is we've acquired about, we've negotiated definitive binding agreements that cover about 1,225 hectares worth of area in the Delta, about 3,000 acres. We expect to recover tailings using a dredge system and recover metals using conventional flotation technology. So this is really important. It highlights our site-specific approach. The technical risk here is very, very low. We're dealing with conventional flotation. Really, our opportunity here is the geometallurgical approach, that forensic geometallurgical approach that allowed us to identify this opportunity. And we'll look at the resource here in just a moment. So a little bit more information on the Buckens project. And you can see here on the left, just for scale, the Buckens River that empties into the river delta here. This delta here is where the tailings ultimately, where the deltaic tailings deposit was formed. The delta is about 3 kilometers across. There's about 2 meters of water over those tailings. And depending on seasonal conditions, there can be more or less water there. You can see a little sort of an artifact on the Google Earth image there that shows that some of these tailings are exposed and not covered by water, but the water there is relatively shallow. If you look here at the right, this is where it gets really exciting in terms of the potential of the Buckens project. You can see here in the center of the Buckens project, a Sarco actually drilled here in the 80s, recognizing the potential to recover metals from these tailings, found about 2 million tons of resource at about a gram per ton gold. We've identified with an independent geophysics survey about, well, I should say indications of substantial additional tailings. We think it has the potential to double the Buckens project. I won't dwell on Buckens too much longer in the interest of time, but happy to take any questions. We are remediating a salmon spawning ground. Recent analyst estimate covering the project identified 450 million in EBITDA potential, 350,000 gold equivalent ounces. So it's doing good to do well. We'll look at the Australia project real quick here. This is a very exciting project. Very importantly, it's an operational site. It's a permitted site. It's got plenty of infrastructure. We expect to be in commercial metal production at this site. And if you look at the opportunity at the site, it's absolutely tremendous. Over 600,000 ounces of gold, about 23 million ounces of silver. Those numbers coming from a recent 2020 JORC technical report at the site. And the current operator there primarily producing a lead zinc concentrate, getting 5 to 6% recoveries for gold, very little of the silver, almost none of the copper. We're able to come in, we've demonstrated, actually we released just recently 83.4% of the gold recovered, validated with an independent metallurgist, a leading metallurgist in Australia, and 94% of the silver. So you can do the quick math there, tremendous economic opportunity. Again, it's permitted, ready to go. We expect to be producing metals here in 2022. Again, the analyst report, they're identifying almost $1 billion in EBITDA potential from the production of about 900,000 gold equivalent ounces. Again, in the interest of time, I'll just run through some numbers here. So the analyst reports that the report that covered our company did a deep dive on just 2 of the projects we looked at today. So the 6 additional projects in our pipeline and growing is basically free upside. And what we've got there is a fair value per share estimate of about $1.40 per share. Obviously, we'd expect that number and that potential to increase as we bring more projects online. We're trading at about 50 cents per share today. And I'll just wrap up here with a few of the major catalysts that we expect for the rest of the year. We recently announced the finalization of the Hellier Tailings Reprocessing Agreement, major milestone and catalyst for us. We very shortly expect to announce the Hellier project financing. That's going to be a very exciting development. We are already having very material discussions, and we're well along the way to securing the financing for Hellier. We'll then announce publicly the strategic operating partnership with the global EPCM, publish the Buckens resource estimate. That'll be a major development. Continue to announce the development and essentially bringing online other major projects. And then, of course, the largest catalyst of all, producing gold, silver, and copper in the 4th quarter of this year at the Australia project. So the chart there on the right kind of showing the continuous march to the realization of that net asset value. So I know time's tight. Kobe, I'll turn it over to you. We'll take any questions.
Awesome. Well, thanks for the presentation, JC. We have some questions here. So, those recovery rates at Hellier, they're quite an improvement from the last. So first off, congrats on that. And we know that what works in the lab might not necessarily work in the field. So, the question is, do you expect you'll be able to achieve these recoveries in the field as well? Do you think that these numbers are more of an average, or are they sort of a maximum or an uppercase scenario?
Yeah, that's a fantastic question. So the key thing there, right, is the partnership with the global EPCMs and the partnership with Core Resources. They're a leading specialist metallurgical group, as well as a process development group. So absolutely, it's not just the recovery rates. We have detailed technical studies, essentially creating a proprietary flow sheet for this site. So there's always going to be that implementation risk, but that's where the expertise of our team comes in. That's where the partnership with leading global EPCM companies comes in to reduce that execution risk when we look to implement. And frankly, the margins are so high, even if we didn't realize the recovery rates of 83.4 and 94, there's still a very, very attractive project there.
For sure. And yeah, you've got a financing that's ongoing. Tell us about that. How much are you hoping to raise? And tell us where these dollars are going.
Yeah, so we were very pleased to announce the closing of the first tranche of the financing. There'll be 2 total tranches. The first tranche was led by insiders and management, about 1.1 million, just showing the support that we have internally within the organization. We'll look to raise about 5 million Canadian. We'll look to close relatively soon here. We've got a lot of interest in the round, and it really highlights sort of the modest operating capital requirements that we have, because we do have a project-specific financing approach. So that corporate financing essentially allows us to accelerate the development of our tailings reprocessing portfolio, bridges us, we expect, to commercial metal production, covers a little bit of operating costs, and then we'll look to do the project-specific financing for Hellier and Buckens. So very exciting. Accredited investors can reach out. My contact information is in the press release.
Great. So we have a question here. What are your reclamation liabilities? Will that include any legacy liabilities or those that are retained by the mine owner? Or are those retained by the mine owner?
Yeah, so those would typically be maintained by the mine owner. Again, we don't own the sites. We come in, we reprocess the tailings. It's sort of a reprocessing as a service, if you will, business model. And then, of course, Dr. Mark Thorpe, PhD in mineland rehabilitation, that's really his sweet spot. So we understand those risks before we go in, but our business model sort of fundamentally sidesteps some of those liabilities.
Speaking of Mark, where is he?
So Mark is doing what he, I would hesitate to say it's what he does best. He's an amazing, amazing leader of our team, but he's in the field at Buckens right now, having some very productive dialogue with some key stakeholders there. So very exciting news coming out of Buckens in the relative near term.
And yeah, Buckens, you guys are currently core sampling, right?
That's correct. We've just started the core sampling program, again, highlighting the efficiency of our approach. We submitted the permit after the independent geophysics study. A few weeks for approval. We've got great relationships with the regulators there. And then because we're coring material that's on the surface, instead of, a single hole that's 100 meters, there's 500 meters of total coring over 99 holes. So very efficient, very cost effective. We expect to produce a Buckens resource estimate that's NI 43-101 compliant in the relative near term.
Awesome. So there's a company called Australian Process Engineering that I believe owns about 3% of your shares. Who are they?
Yeah, that's a great question. I mean, look, there's some confidentiality questions there. That's basically an insider of the company. So if you look at our shareholder register, right, about half of the shares issued and outstanding are owned by management and insiders. So we eat our own cookie, so to speak. And then the majority of those shares are subject to escrow agreements. So our shareholders are committed, they're locked in, they wouldn't sell even if there wasn't the escrow agreement. But we think that escrow agreement sort of gives people more of a peace of mind and really lets them know that we're aligned with creating long-term value for shareholders.
Okay. All right. So, what does this Hellier project financing going to look like? Are you guys going with mostly debt, or is there going to be an equity component? What kind of interest rates do you think you'll get?
Yeah, I'm happy to answer that. But Zoya, we've got our
okay. Thank you. Thank you. Yeah. Well, we getting the term sheets ready. We expect it to be primarily debt. However, it remains to be seen what kind of the final project financing, what it's going to look like. Most likely it's going to be tied, like as a typical project financing, most likely it's going to be tied to the production stages at Hellier, and with the repayment starting let's say, a year after their commercial production is achieved. So basically 2 years from the date of the first drawdown. And we expect it to be staged, for according to the stages of the project. So the stage 1 is going to be 500 ton per day plant, and so smaller drawdown on the project financing of about maybe 20 to 25% of the total amount. And then once this 500 ton per day plant is operational and it is scaled up to 3,500 ton per day, then the second drawdown can be made and scaled up to the full commercial production amount.